All right, we're just about there. We have one more speaker. Elaine Cubb we'll have coming up here, and it's my privilege to introduce Elaine. She is an author of the Mastering the Grain Markets, How Profits Are Really Made, a 360-degree look at all aspects of grain trading, which draws on her experiences as a commodity market analyst, futures broker, grain merchandiser, and farmer. Cubb's analysis can be found on DTN, The Progressive Farmer, and on various radio and television programs, including Market to Market, Market Journal, and U.S. Farm Report. Please join me in welcoming Elaine Cubb.
Thank you for the introduction. I have to confess, after Jack's presentation, I'm not feeling terribly clever right now. I didn't see the gorilla, I didn't get the pistol thing right, I didn't count the number of F's right. But you're stuck with me anyway, I'm who you got. So yeah, my name is Elaine Cubb, and the presentation is titled today, Prepping for the 2019 Grain Markets. Prepping, like doomsday prepping, like prepping for the apocalypse. Now, what do we mean when we say the apocalypse? Just generally, we think about nuclear disasters, hiding out in a bunker, in a nuclear bunker. We think about, an EMP coming from a solar flare and taking out all network communications across the Earth. We think about generally just worst case scenarios. And honestly, it kind of felt like 2018 was a worst case scenario for the soybean market, certainly. Losing trade with China was a big blow. And so that was the theme that I put together for the presentation today, is just sort of this apocalyptic theme. What can we do to prepare for the apocalypse? And I want to promise you it's not going to be all doom and gloom, and it's just kind of a lighthearted approach to it. But let's think about apocalypses. Honestly, we all know this. I don't watch Doomsday Prepper like the shows on Discovery Channel or whatever, but I have thought about it. I've thought about the ways that farmers are uniquely prepared to handle an apocalypse, honestly. We were talking about this last night. If you grow dry edible beans and you've got a bin full of dry edible beans on your farm and the apocalypse comes, that's lots better than a bunker full of canned food from Costco that has a 25-year shelf life. If you're growing corn, obviously we know corn is the most useful substance on the planet, right? You can eat it, you can make it taste better if you feed it to livestock and then eat it. You can turn it into fuel, and you can replant it. Soybeans, you could, I think in an apocalypse, if you have a bin full of soybeans, you could mechanically crush that, and I think with minimal additives, you could run pure soybean oil in your diesel engines. So, farmers, we are pretty well prepared for an honest-to-goodness apocalypse, but how well prepared are we for a marketing apocalypse or a grain market apocalypse? What are the fallout shelters or the shelves full of canned goods that we have in this metaphor that can tide us over into 2019 when we are still seeing some of these worries about trade? I'm just going to set the stage here a little bit. This is a chart of the S&P 500 index, so a proxy for the stock market or the U.S. stock market. And it goes back weekly from 2014 until about last week. And the big scary part here was that crash in December. And we really started to get more global economic organizations worrying about the big R word, recession. And part of the problem was, so this green line on here, it adds in the S&P Goldman Sachs Commodity Index. So it's an index of a lot of different commodity prices all put together, most highly weighted in crude oil. But the problem that you can see here is that there at the end of 2018, in November and December, both of these market segments were moving in the same direction and moving downward. Historically, we expect to see a negative correlation between these two sectors. So if raw materials like crude oil starts getting cheaper, then businesses start to be more profitable, and sometimes the stock market does better. But in this instance here, at the end of 2018, everything was falling apart. And that suggested to me that, in particular, that collapse in crude oil prices, it wasn't just a matter of OPEC putting out more supply. It was actually a matter of global demand and scary concerns about global demand. If this is the US stock market here in the white, I should have put a Chinese stock market chart up here too, because that fell apart even worse. I think the biggest worry right now for global growth, or a slowdown in global growth, is a slowdown in Chinese growth. The US is starting to recover here. But even this, I just want to emphasize, is not a totally apocalyptic scenario. The stock market lost 6% in 2018. That's not as bad as it could be. We'll go on, but just keep that in mind when we come back to this. Okay, so that green line is still the Goldman Sachs commodity index, so the entire commodity sector. But let's look at how corn fits into that. Corn is the yellow line here, and you can see it's been pretty flat. In fact, it's been what we call range bound. And this chart is going back to 2014 up until about last week. And that front month corn futures contract has not gone below 301 per bushel or above like 439 and a quarter per bushel in this entire 4-year period. And both of those prices were hit in 2016 when we had a little bit of a spike, a weather rally in 2016, and then back down to $3. But this is pretty much where we're stuck. And if I had to end my presentation right now, I'd say, yeah, there you go, those corn prices. This is what it is. I feel like we are in a pretty stable scenario, and we're likely to continue in this sort of neutral range-bound area simply because of a balance of supply and demand. But let's dig deeper into it. This is no longer the front month corn futures for the old crop. This top chart is December 2019 corn futures, so you're looking at new crop opportunities. And it's a daily chart going back to last November. The green line is the important line here. That's the estimated break-even cost of growing corn in North Dakota in 2019. So shout out to the folks from NDSU, because they're the ones who put together these numbers, and you can go to the extension website and fill in your own numbers and figure out how your break-even costs, they may or may not match this 337 number. But if you were going to write down a benchmark number for North Dakota corn in 2019, that's the number. You need to get a cash price of $3.37 per bushel in revenue in order to pay yourselves back for the cost of planting the corn. And that's assuming you're going to grow this corn at 145 bushels per acre, and it's assuming you're paying a $95 land charge. So if your rents are higher than $95, this green line starts to rise dramatically. If your yields, if you can honestly expect better yields than 145 bushels per acre, and many of you can, then your green line starts to go down. The green line here is not at 337, it's at 377, so that adds in the assumption of 40 cents of basis, which I now realize is probably not totally realistic. I probably should have put in more like 60 cents of basis, which means that that green line would move up to 397, and that means the opportunity being offered to you right now by the futures market at 402 or 403 is profitable, but just barely. So you need to figure out what your number is, right? Like, is your number 337? Or where is it? And how much profit do you have being offered to you by the futures market right now? Because this is suggesting, if you're assuming 40 cents of basis, that there is profit right now. There's like 30 cents of profit potentially, 20 cents, whatever. Whatever that profit is, let's say that's somewhere within a 2 to 7% return on your investment. And we talked about the 40% return on investment in seed research. We talk about the stock market losing 6% last year. Yesterday, one of my neighbors had a Snapchat. He had just spoken to his farm lender, and he said, gosh, we just kind of decided that farming is just a big gamble. Well, it can be, or it can be an investment, right? And I think that's probably what your lenders would like you to think of it as. Yes, there are huge sums of money involved in buying the inputs, but there should be huge sums of money coming in as revenue also. So is the revenue going to be more than the inputs? And here the possibility is there. And to turn this into an investment instead of a gamble, you've got to be locking in those profits. If you don't lock in the profits and you let them just wither away as time goes on, now you're honestly gambling. Okay, so same exercise for new crop soybean futures. This chart again is going back to November 2017. Daily, the break even according to NDSU extension calculations was $7.72 per bushel cash for soybeans grown in North Dakota in 2019, assuming 37 bushels per acre yield, and again assuming that $95 land charge. So if you assume that, and if you assume $1.25 of basis, I think I've got the basis on here a little more realistic. This 772 cash break-even needs to be an 897 futures price in order for you to be able to lock in some profit. And yes, the futures right now are above 897. They're above 897 by, 60 cents. So according to this, there's opportunity to lock in profit in soybeans. And I know that a lot of people are working out budgets and they're not, they're not coming to these same conclusions. They need more like an $8 cash price. And in fact, if you look at different states that are working this out, like the Nebraska extension, their corn break-even matches pretty close, like 329. I think the Iowa break-even matches almost exactly at 336. But the soybeans are a little more wild. And if you look, like the Iowa states, their break-even calculations for soybeans right now take them above $9 somewhere. So they're looking at an unprofitable scenario, and that might be more realistic. But again, that's just to emphasize the importance of you going home and doing this exercise yourself, having a number in your own mind, so that when the profitable opportunities present themselves, you can lock those in. All right, let's go into a little more detail, and again, the doom and gloom scenario of the real apocalypse that's been going on, and that is old crop soybeans. And the chart up here is an old crop soybean chart, and it's not very large, and that's fine. We don't want to look at it anyway. Just ignore that. Okay, so here we go. This is it right here. So this is the soybeans that are caught in the U.S.-China trade spat, and it's showing the normal seasonal pattern of Chinese purchases of U.S. soybeans. 2006 is in the yellow, 2017 is in that kind of duller yellow, 2018 was in those darker orange ones. And you can see the normal pattern from 2016 and 2017 is you ship a few in January, February, nothing happens in the summer, and then you need to be hitting that export market hard in October, November, December. So when the trade spat started, when the trade war started, let's call it a trade war, in the tariff scenario, the Chinese hit us with this 25% tariff on soybeans. The timeline of that was what, May, June? That's when we started to be really worried about this? It kind of didn't matter. I mean, we wouldn't be shipping out soybeans then anyway. Everybody's going to get it sorted out. It'll get fixed. We'll come up with a better scenario for IP protection. And everything was fine-ish. And it wasn't fine on the futures market, obviously, but it doesn't matter because maybe farmers we weren't obligated to price soybeans when the futures were low. You could just wait and hope this would sort itself out. But then harvest happened, and that time frame when we really wanted to be shipping soybeans happened, and we did not ship the soybeans. So there's this big gap in there in those orange bars from October, November, December even. Now, we don't honestly have the numbers from January, right? We are missing some government reports to show us what the export sales have been in January. That's okay. We kind of know that it's been in the 5 or 6 million metric ton area, which is good, actually. That's a pretty good chunk of business. The actual export inspections, the actual physical pace of shipping out those soybeans is still down 40% for the marketing year. So we haven't fixed it. We haven't plugged this hole of soybeans that have been missing. It needs to be a lot more. A good question came up last night. Well, what's the magic date? What's the date by which we need to have this trade war solved or get these soybeans shipped beyond which it's too late? And that's a really good question, and I think it is a question that we could calculate. The data is there that we could figure that out. I haven't done it, but I intend to. I'm going to write a column on this because that was a really good question. But if I had to guess, I would guess that the magic date is probably something like March 1st or March 15th, which coincidentally is the deadline on this sort of truce that they have in the trade war. I say that because eventually you're going to have Brazilian soybeans coming back on, right? Back when the trade war got started and U.S. soybean prices really fell, there was a $2 spread between the price of Brazilian soybeans and the price of U.S. soybeans, including that tariff. That spread has now collapsed within the past 3 weeks or a month. It's now only 50 cents difference. So this is helping the U.S. soybean business right now. Some of this business that we are seeing is because that spread has tightened. But once their harvested bushels start coming to port, and they're at about 12% harvested right now, it's got to truck its way down some pretty gnarly roads and get itself to the Santos port. But once those soybeans are at the port, certainly by March, I suspect that spread will widen back out again if we haven't solved this tariff scenario. So we have a very limited time frame to plug this hole. And yeah, so we're all just playing, it's brinksmanship, right? It's playing chicken on the railroad of when this will get solved. We can observe some of this even without export sales numbers or without any government reports. We can observe simply in the soybean futures spreads whether or not the commercial side of the market is still feeling that there's an excess of supply of soybeans sitting around, and they do still feel that. And we can observe it also in soybean basis. Anywhere west of I-29, soybean basis is more than $1, up to $1, I don't know, 50 in some western parts of Nebraska and North Dakota. None of that has changed, so that suggests that none of this has really changed. We could also observe it in shuttle freight prices, and if we started to see those get really hot, then we would know, even without export sales reports, we would know that there was more business being headed to the PNW. But we have seen shuttle freight prices have come up maybe like $100, but not enough to make me think that anything has really changed yet. Okay, so again, more of this prognosticating of how can we see what might happen in the future. If a futures market, a commodity market is balanced, you expect to have what they call put-call parity. So look on the green table here, you've got corn options, let's say March corn options at the money, 380 put options and 380 call options. Those are both priced at 7.5 cents. So that suggests that the population of options traders are as willing to put their money to make a bet on the fact that the corn market might go up as they are willing to put a bet on the fact that the corn market might go down. That market is imbalanced. The put and the calls are at parity. But in the soybean market, in those options, they're not at parity, and they haven't been. I've been watching this since that October-November timeframe. Do you remember all during the month of November, we kept hearing that there was going to be a meeting between the US and China at the G20 summit. They were going to get this all sorted out. And so what I noticed in the soybean options is that there was a lot more appetite for buying those call options that suggest a bullish bias to the soybean market. And we saw call options being priced at the money call options being priced as much as 8 cents higher than at the money put options for soybeans. There was a lot of expectation for upward potential in the soybean market. That 8 cents optimism has sort of gone away. And even last week at some time, the soybean market had kind of gone back to put-call parity, and it felt like that optimism was really fading. The other day when I pulled these numbers, there was still a bias toward the call options instead of the put options, but it sort of fades. So on any given day, you can kind of get a sense of how the options traders, anyway, are feeling about the potential for upward movement for soybeans. In fact, we could argue this is not necessarily a reflection of the optimism for upward potential, as it is just a sense they can't really go down anymore. I don't want to say that soybean prices can't go down anymore, because they can, but they kind of, I think we've already factored in all the bearishness there is. So we've got to stay flexible in 2019. That new crop soybean to corn price ratio is currently 2.37 to 1. So over a 10-year average or 15-year average, it's usually 2.5 to 1. So if you've got $4 corn futures, which you do, then you expect to see soybean futures at $10, 2.5 times the price of corn. Well, we don't have soybean futures at $10. We have soybean futures at $9.55. So it's off by 45 cents or so, off according to where it should be in a historically normal world. But being off by that amount isn't outside the realm of normal. This is about 1 standard deviation away from the normal soybean to corn price ratio. So this does suggest that this would favor corn acreage in 2019, but not by a huge degree, not by a massive shift in acres. And we saw that today Informa put out their projections for 2019 acreage, and I largely agree with them. I think they're talking about, so last year it was 89 and 89 corn and soybean acres, 89 million. And Informa is now projecting corn to go up by 2 million acres and soybeans to go down by 2 million acres. I think that seems pretty fair. It's a pretty good expectation. Wheat to stay flat. However, we don't know yet. There's a lot to be yet decided. We have not yet seen the February crop insurance reference levels. We have not seen what spring weather is going to do. So I wouldn't worry too much about what the acreage projections are right now, but just see that the economics are suggesting more corn acres. And once the market starts to filter that in and factor in larger corn acres, I believe there's downward potential in the corn market. So after the fall field work, we do know the minimum corn acres because the fertilizer that went in the ground, but we don't know the maximum. It could certainly go up from 92 or whatever. You can make up a number. And the potential to return seed and inputs. So I think this is a year when farmers, if I was going to give advice about marketing, this is the year to really incorporate flexibility into your marketing plan. Now, I assume everybody in this room has a very sophisticated either software program that they're working with or a spreadsheet that they're working with, and they know exactly what percentage of their grain they have sold at any given point in time. I'm sure everybody does that. But if you don't, this is the year to do it. Even if you just write it down on a piece of paper to really know that I want to have 20% of my crop sold at this point in time, but what is 20%? 20% of your crop is going to change drastically if your acreage plans start to change. And ultimately, it's going to be changing right during that planting time frame. So we have to be a little proactive. Speaking of weather, yeah. So we do sort of expect this time of year, sometimes we get a little bullish about South American soybean production. And we can feel a little bullish about South American soybean production because it has been dry. They're receiving some rain this week, but not enough rain to really boost that late pod filling time frame that they have in that Rio Grande do Sul area where this is showing that it's below normal precipitation forecast. So the private estimates for the soybean crop size in Brazil keep on being trimmed down and down, 115 million metric tons. It's still gonna be enough. It'll be enough to supply China if they want it. And again, let's talk about weather. So this is the Palmer Drought Index of the United States soil moisture conditions. Some years, you'd put a chart up like this in January, almost February, and it's a little bit ridiculous to be talking about North American weather as a market factor in January. But if this was terribly dry, so if there are years where we start out really behind on soil moisture, if this was terribly dry and you still had drought in Kansas and Missouri, if that was still the case, then you'd look at this and you'd start to feel a little bit bullish about new crop prices. You could make that case even in late January. But this is not dry. Most of the Corn Belt is showing somewhere between extremely moist soil to unusually moist soil. So we're gonna be starting the spring not behind. So it's not a bearish picture necessarily, but it's certainly not a bullish one. All right, this is a bearish chart. This is the most bearish slide I have for you today, and it's gonna take a little time to explain what's going on here, but bear with me. Okay, so all of the black dots are US average corn yield going back from 1866 all the way to 2018. And all of the green dots are North Dakota average corn yield going back from 1880 to 2018. So just because I'm a statistics nerd, I want to point out some interesting things here that the North Dakota ones, this is reflecting agronomic reality. All of this is reflecting this, is that the North Dakota ones tend to be lower than the US average because especially back in the 50s and 60s, there wasn't corn seed that would handle the shorter days. There was just less yield potential in a shorter day time frame. But that gap between North Dakota to the United States has closed in the past 5-10 years because corn hybrids have sort of bridged that gap and made it possible. It's also true that there's just more wild variation in any state's numbers. You're going to have more variation in these green dots than you would have in the black dots because the black dots have the power of averaging all across the United States. Even if you put up Iowa numbers, which track the same path as the black dots pretty closely, they're more wildly in variation just because it's a rain-fed state, and they have some years that are good and some years that are bad. If you put Nebraska dots up here, it pretty closely tracks the United States average, and the standard deviation is actually much smaller because it's such a largely irrigated state that they have very predictable yields. So that doesn't really matter to prices, but I just think it's cool. So let's talk about the trend line of this. This is the bearish part of this chart. I've put on here a linear trend, which doesn't fit it very well, but we used to always think that corn yields in the past 10, 15 years were sort of linear, that they were gaining, on average, about 1.1 bushels per year. But the much better fit, if you're going all the way back to 1866, the much better fit for this trend line is a second-order polynomial, and that's the line that sort of, like Jack was talking about with the exponential growth, that you start to grow more and more year after year. And we could follow that second-order polynomial trend to figure out when the US average corn yield might reach 300 bushels per acre. I remember about 10 years ago, I was at a conference where Steve Fried from ADM was talking about 300 bushel per acre corn, and it just blew my mind. I was trying to picture how many grain carts you'd need to harvest a field like that. And there's folks who are capable of growing 300 bushel per acre corn even now. But we're talking about as a nationwide average. So this chart, this line is here. We can do the calculation, but when do you think it is? Tell your neighbor, or guess with your neighbor, what year do you think, according to this trend, if this continues on into the future, what year would we reach 300 bushel per acre average in the US? Any guesses? Anybody think 2000, beyond 2025? It is, trust me, it is. Yeah, beyond 2050. It is actually, it's 2057. But that's within, I hope it's within my lifetime, God willing, right? So, so if this just continues in this upward direction, by 2057, in theory, the United States will be growing on average 300 bushel per acre corn. Now this is assuming that this trend continues like this and doesn't start to plateau, which it could do if you had something weird happen to the climate, like if you had an actual honest-to-God nuclear war or something. I could imagine corn yields starting to fall back down. But if this just continues on the present path, that's what we're talking within our lifetime. Now, this is so bearish because you can't have this expectation that you're going to have a big bullish change in yield from one year to the next. I was in a hotel room a couple weeks ago and had Bloomberg TV on, and they had a commodity market commentator, and they were asking him to comment on every commodity. Crude oil, natural gas, silver, all the metals, cotton, corn. And listen, that gets hard. I know, I have to do this on TV sometimes myself. And one time CNBC had me on and they had me talk about jatropha, which is some crazy edible oil from Africa, and I'll be honest, I didn't know anything about it. My point is, people talking on the TV sometimes don't know what they're talking about, and that's, I have sympathy for that. But this guy, they were asking him to talk about corn, and he said, corn's going to $5 in 2019. And she said, well, why? And he said, well, in 2018, there were record yields, 178 bushels per acre. So in 2019, yields will revert to the mean, and yields will go down, and we'll have $5 corn. Well, no. I want you to get that out of your head. We should expect, as just the natural order of things of improving yields and improving hybrids and improving seed technology, we should expect as the natural order of things that yields will increase every year. Every year we should have new record high yields. And that's not so there's no reason to expect mean reversion in US average corn yields. And it would be more fun. Listen, it's more fun as a person who gets up and speaks to groups of farmers. It would be more entertaining, more pleasant for me if I was here to give you a really bullish story, right? If I was that guy saying, corn's going to $5, woo! We all leave in a good mood. But I don't want to be that person because I don't think that's very responsible. I want everybody in this room to feel reality, especially because reality is what you need to make decisions off of, what your lender wants you to make decisions off of. So I don't want people in this room to get really bulled up. I'd rather that you accept the profits available to you and lock those in. Okay, so that's the supply side. Let's talk about the demand side of where does all that corn go. And this chart here was made as of the last weigh-in of the USDA and their World Agricultural Supply and Demand estimates, which we no longer received in January, but it's okay. It really doesn't matter whether that ending stocks number is 1.74 or 1.76, it doesn't matter. But just as a general rule, we can kind of get a look at who are the corn industry's customers, who are our customers' customers, how are they doing? The biggest one is livestock feed, whether it's directly being fed or whether it's being fed as part of that 30% of the ethanol usage that comes back as DDGs. Mexico buys 4% of the US corn, Japan buys 3% of US corn, all the other countries combined buy about that same amount of corn. But is this stuff profitable? Yes, like just barely. Just within the past week or so, the ethanol margins start to pencil out. And it's largely due to the rebound in crude oil prices and in RBOB gasoline futures that are back up to about $1.40. So this helps when we no longer have that terrible recession-y scared bearishness from December. When you have crude oil recovering and energy recovering, that is what has allowed the ethanol sector to start looking a little bit more promising or a little bit more optimistic into 2019. I did include some charts about livestock to talk about that sector too, upon popular request. So we've got here the June live cattle contracts as of last week. This doesn't include yesterday's sort of collapse. But we have seen an improvement in live cattle futures over the past couple of weeks, and we've seen a simultaneous fall in feeder cattle futures and simultaneous sidewaysness in corn futures. So if you're just penciling this out as the futures crush spread, the cattle crush spread, you do start to see some daylight and some better opportunities for cattle feeding. And I know that people will quibble with that, depending on how much you have to spend for hay, and DDG prices have gone up during some of these ethanol plant shutdowns. But if anybody in this room is feeding cattle, for instance, and probably feeding their own grain and their own hay, this might be a good opportunity if you're looking at marketing into that April timeframe. If you're looking at marketing past June, July, I'd still wait. Hogs, I don't know how many folks in this room care about hogs, but hogs are really interesting right now because there's this idea of the African swine fever. And this chart is a little bit hard to read, but it's showing hog futures. The green one is the nearby hog futures, and then the white one is April, and then it goes farther out from there, the darker the colors go. So you've got July is the purple line up on top, and August is the blue line. So basically what he's showing is that as the time frame gets farther out, as we start looking into that July-August time frame, the expectation for hog futures will be to go $80 or more, because we keep on expecting a few months down the line, China is going to have to come in as a huge buyer of US hogs because all of their hogs are going to die from the African swine fever. Well, we really don't know. We really don't know. China has come out and explicitly said that they expect 20% of their swine herd to die of that African swine fever. I don't know why they would say that, honestly, unless it's just sort of a signal to the soybean market that they don't need our US soybeans because they don't have any hogs left. Maybe it'll be more than that. Maybe it'll be less than that. We do see this, hog futures have sort of dwindled in the past couple of weeks because we've been expecting to see this big surge of Chinese buying, expecting, and it just hasn't happened. It might be a story that just continues to be 6 months down the road, and then next month it'll still be 6 months down the road. This is a real big mystery, but anyway, it looks like there's money in having US hogs this summer. Okay, so back to this. I wanted to talk more about that idea of the ending stocks number not really mattering. Has anybody here missed the USDA reports? I kind of raised my hand about halfway. I miss the data stream. Like when I go back and look at historical data, I miss it when there's that chunk from 2013 and you can't see what really happened. I miss being able to compare one time frame to the next. I don't like having this data interrupted like this, but I didn't really miss the January WASDE report because I don't know, who cares? There's enough of the stuff around. You can see it from the future spreads that are showing, 70% of the cost of full commercial carry for corn into July. No one is real worried about running out of corn with this much left in inventory. And there's actually an economic theory about this. It's called the convenience yield, and it goes back to like John Maynard Keynes in the 1930s and some other economists that we've never heard of and don't matter. But the idea is that you could predict the price of a commodity 6 months into the future by saying that price will be equal to the spot price today plus the storage costs to carry it 6 months minus a convenience yield. And a convenience yield was just sort of this nebulous economic idea, being that the industry finds it convenient to have a lot of the stuff in the supply chain. And if you start running out of it in the supply chain, or the supply chain's getting spotty, that's terribly inconvenient for an industry, and they're willing to start spiking things up. It's the idea of like price rationing. If you start running out of it, then you get a price spike, then you have price rationing, then things get interesting. But as long as there's enough of it in the supply chain, that is convenient, and prices, or the price pattern, just kind of reflects the cost of storage. So we see that in corn, and we see that in wheat. This chart is kind of funny, and it's going to take a lot of interpretation, bear with me. But the reason I'm showing you a wheat chart that goes back to the year 1750 is to emphasize this idea of a convenience yield, and to emphasize the idea that a commodity market or a grain market doesn't really spike, doesn't really have a rally, unless you have some suddenly strange shortage in supply. And we are not currently expecting any suddenly strange shortage in supply. So wheat prices, going back for the last 238 years, I collected these, actually last year in Grand Forks, somebody came up to me and suggested that I look into the 60-year price pattern in wheat prices. And I thought, well, that's going to be really tricky. That'd be impossible to ever prove. You're never going to have enough chunks of 60 years to prove that there would ever be any price pattern. But I thought, you know what? I could just, I'll give it a try. You could almost do it with wheat, because there are futures, or there were wheat contracts being traded in London on the London Corn Exchange as far back as 1750. You could never study a 60-year price pattern in soybean prices, but you could do it with wheat. So I went and I got the English cents per bushel from 1750 to 1860, and then 1860 through 1960 is in US cents per bushel, and then 1960 onwards is just from my charting software. But the point here is that the only times you see spikes historically, in reality, reflecting the real prices of these commodities, the only times you see prices spike is when there's some suddenly strange shock to the supply. For instance, the Napoleonic Wars in the early 1800s, or World War I in 1919, when Europe had to import a bunch of US wheat. And then, within the past decade or so, we did see more of a demand-driven change in the overall price level, because you've got a world population that is consuming a more sophisticated diet. But again, you're really only getting those weird spikes, like in 2008. Another funny story. I was in Williston, North Dakota, speaking at the Durham Wheat Convention on February 4th, 2008, the day that spring wheat hit 25 and then collapsed after that. But that was certainly one of those spikes. That's the kind of spike that we all hope for, that we all want to market our grain. But I don't feel like we should expect to see that in wheat or corn. Although I did see today that Russia is once again thinking of potentially they might shut down their exports. So we can feel a little bit bullish about wheat. I do feel a little bit bullish about wheat. Oh yeah, I've got another wheat chart here. This is an acreage chart. And again, the private estimates for 2019 acreage for wheat so far are looking pretty flat, and that makes sense. This is showing overall US wheat. So as you can see, these bars just kind of dwindle from 1978 to 2018. We've lost wheat acres year by year. It sort of falls out of favor. But the North Dakota spring wheat is the green parts of the bar, and North Dakota other wheat is the dark green. Minnesota spring wheat is the orange. So spring wheat has been more stable, or it has kept a more stable acreage base than US wheat overall. And I would expect that to continue in 2019 for various reasons. And I know that you look at prices right now and don't think they're great, but I am starting to see a recovery in the price ratio of spring wheat compared to Chicago wheat that could continue to take spring wheat towards $6, let's say. It's something that I would look for within the marketing year. Yeah, and has anybody ever seen this map? I have a heck of a time trying to find it. It's a USDA map of North Dakota, and all of the various colors on here represent acres of crops, and I'll interpret the colors for you shortly, but I usually include this slide when I'm giving a presentation in the state of Iowa, because the beauty of this slide is a pictorial representation of diversification. And if you have the same map for Iowa, the entire state is either green or yellow, which is corn or soybeans. And there's not even pasture, there's no forest. I mean, that's just corn and soybeans, 50-50. That is not diversification. A map of North Dakota, however, is a poster child of diversification. All of the green here out west, especially, that's pasture. The red they just call small grains, so that could be anything, barley, etc. Beets are way up they're kind of an orange color. Let's see here. Soybeans are the yellow over on the eastern side. Durum is the purple way up in the northwest. There's some fallow color woods. Canola is the blue up in the north central part. So that's showing you this nice, beautiful, diversified, lots of colors. Lots of colors is good. Keep this in mind when we start talking mathematically about diversification, which we are going to come back to. But first I want to talk about when should we be doing our marketing. If I have convinced you that you do not want to just sit tight and hope for a rally, because it might not happen in 2019, if I have convinced you to be proactive and be a good marketer ahead of time, then we got to think about when. When do you want to do it? Do you want to do it before the insurance prices are set in February, which would be unusual? Farmers typically like to wait to more of a spring time frame. Or, what's a good time? What's the magic date? And I actually did a study on this. I wanted to be able to say, this is the day on which you should sell all your grain. You should never do that. You should never sell all your grain on one day. You should sell it in chunks, but whatever. I wanted to do the mathematical study. So I put together new crop December corn futures for the past 18 years, and I put them on a chart, and I figured I could see that, a seasonal pattern on that chart, and you could see what season of the year or what date of the year you tend to have the highs. So here's what that chart looked like. That's not terribly helpful. That's kind of spaghetti. But fortunately, I could find a few segments in here. You could segment this out according to what kind of year you were experiencing, according to that convenience yield and how much inventory you have. And there were patterns. There was a trimodal distribution here. If you had a normal abundance year where you just had enough corn, this is corn, these charts are, then it didn't really matter. Don't care about the prices so much, but the pattern of the prices. What is the date of the year when the market hits its high? And then you average those dates together, you can get the date that I would say, historically, you have the highest probability of seeing the corn market, the new crop corn market, hit its high. And that date is June 18th. So you can write that down, sell all your corn on June 18th, and then sue Elaine when it doesn't work. Don't sue me. Futures and options is a risk of loss, and past performance is, how does that go? Past performance is not indicative of future results. Yeah, don't sue me. Especially not this year. I'm going to get into I don't really feel that this is the pattern we're going to follow in 2019. But it's an interesting chart to see. And in fact, the first year I did this was in the winter of 2016, and then in 2017, the corn market did hit its high on June 18th, and I looked like a genius. Last year it didn't work so hot, so don't follow my advice. All right, so the difference is if you don't have just a normal abundance, if you do have a shortage and you have a large convenience yield in that theory, then obviously you see a price pattern that again reflects agronomic reality. You see more and more concern about supply building and building through the summer, and you tend to see a high on an average of October 1st if you have a short crop year. But there was a third category of year, and that was a supply crush year. And a supply crush year, as I defined it, was a year of normal supply coming after a year of shortage. And I don't think 2019 will obviously fall into that category because we're not coming out of a shortage. But I do worry that the grain markets are going to follow this seasonal pattern a little bit more, of an earlier high than usual. Because I think corn especially, I think there's going to be a lot of bearishness if we do get into a spring. If you get crop insurance prices that highly favor corn, and you get into a spring that's relatively dry, and folks in the center of the corn belt are able to just plant corn, we're going to have increasing bearishness through the months of April and May, and I think we could just see prices dwindle from here on out all the way down to harvest. I think that's a possible pattern that could happen if the spring weather supports that sort of a planting pattern. So I wanted to show this to again encourage you this year more than ever to be proactive about locking in profits. And if it helps you to compare yourself to your neighbors, well, I don't want to sell corn in January because nobody else sells corn in January. That might be true, actually. There's very little data out there. There's very little data about actual behavior of when farmers tend to market their grain. But last year, Gary Schnittke at Illinois and a graduate student of his, they did do a study. They surveyed a bunch of farmers from like the corn growers associations of 5 or 6 states. But I don't want anybody to draw too many conclusions from this graph or from any of that study, because it was only like 300 respondents, and all of those respondents were really self-selecting. They were already, a population that was active in their corn growers association, for instance. So I think the statistical significance of this is very low. But nevertheless, if it helps you to sort of benchmark where you are, they had a few reference dates. So they asked how many farmers had something locked in by April 1st, or did you have something locked in by July 1st, or did you just sell everything at harvest? And what they found is that most of their respondents had something hedged by April 1st. So 11 to 50% of production hedged by April 1st, 2018. Those are the folks, that's the green bar. Aggressive hedgers who had almost 100%, or so up to 100% of their production hedged by April 1st. That's the dark green bar. And there's obviously not very many people do that, have everything locked in by April 1st, but it's not zero. And the slow hedgers are in the gray, folks who had nothing locked in by April 1st, and those people exist too. But Schnittke and his graduate student were able to then further parse this out, not just did you do that, but who were the farmers that did that? And the ones that had farming as the sole source of family income, the ones with the most at stake, those were the ones who were being most active. They were the good moderate hedgers here. You've got a majority of people whose farming is their sole source of income. A majority of them had 11 to 50% of their production hedged by April 1st. So if that helps to convince you in any way to benchmark your own marketing patterns, is that yeah, folks do. Good farmers with a lot at stake, they do get in there and they lock in some prices early in the year, and then they continue doing it and averaging those prices through the spring and summer. Okay, we're doing good for time. I have one last slide. It's going to get a little far out there. This is a picture. This is my own photograph, and I put it here because I thought it sort of fit with the apocalyptic theme. This is an old grain bin that we had on the farm, and it was a lovely little historical building until it got knocked sideways off of its stone foundation by a windstorm. And I want you to know that I am not a lazy person. I thought of tearing it down myself, but I guess that's my level of lazy, is I just didn't really want to do it. And I thought of burning it down. We didn't want to burn it so close to the other nice big barn. So what I did, you guys know that there's like this barnwood thing on, like the home garden channel, these home redecorators and restaurants and stuff. They love this barnwood, right? So I put this granary on Craigslist. I said, what will you pay me for this granary? And some guy actually drove up from Oklahoma and paid me $300 for the privilege of tearing down my granary for me. That is the best trade I've ever made in my life. And I put it here as a reminder to talk about the idea of diversification, of diversifying your income streams, and thinking outside the box on how you can do that. And I'm not necessarily suggesting that we should all get into the business of barnwood, although the margins are really high on it if you're willing to go tear out a bunch of nails. No, let's think more seriously about income streams, thinking outside the box. What can we do to diversify? So we have had a real case study in 2018 of what happens if you are a farmer with just 2 crops, corn and soybeans, and then one of those crops, the market blows up for whatever reason, in this case a trade war. Now half of your business has effectively blown up. So more income streams, more assets are good. I actually studied, I had a graduate level class with Dr. Harry Markowitz, who is considered the father of modern portfolio theory. So I can walk you through the math of putting together a mean variance matrix of any asset. Like if you're building a hedge fund or you're in your 401k, you're going to put all these assets. You want more stocks and more mutual funds because they're not all correlated with each other. And if one of them goes south, the rest of them might come up with that. Diversification is good, and I can mathematically prove it to you. And I think we all know that in our heart. You don't need me to mathematically prove it to you. You know that putting all your eggs in one basket is not great, or putting your 2 eggs in one basket is not great. It's better if you have more eggs in more baskets. So North Dakota is obviously well positioned because of that colorful map I showed you. You're not just dependent on corn and soybeans. Folks who stayed in livestock are great because you're moving beyond even just the grain segment, you're moving into the livestock segment. If you're able to move into fiber, any other crops, obviously, diversification is good. But diversification doesn't have to just take the form of new assets or new crops. It can think of your entire farm operation or your entire family income stream. If your farm operation is more geographically diversified, that's a source of diversification. If your family income stream is diversified, not just farming, but maybe also selling seed is a traditional thing, right? Being a truck driver is a traditional way. There's lots of new income streams that folks could incorporate in a time of low profits if you're trying to diversify and protect yourself with resilience for future years where you're not just dependent on the vagaries and the finickiness of trade wars. There's ways you can do that. And one of the best ways is off-farm income. And it doesn't have to be, if the off-farm income isn't even correlated to the agriculture market, that's even better yet. And I know that that's not probably something that we're all going to run out and get into the barnwood business, which is good. But it's something that I think young farmers or people that you're encouraging or mentoring in the industry, as they are building their operations, that's something you could encourage them to consider, is the long-term stability of their family income stream. There's a lot of volatility and vulnerability just relying on farming or just relying on 2 crops in farming. So that's my soapbox there. And that's why I wanted to show you the picture of my granary. But other than that, I think that concludes my presentation, but I hope that we have some good questions.
We do have some questions, and again, raise your hands up high. We got mics in the back of the room that we can take questions here from the floor. So just to start here with, can China buy hogs from somebody other than the U.S., and if not, how will they replace that meat consumption if they don't want our hogs?
Yeah, so the other hog exporters are Europe, which is where this African swine fever kind of came into China from. Nobody's got enough supply to meet China. The Chinese swine herd is 700 million head. There's no way that the U.S. can replace that. There's no way that anybody could replace that. Canada can't replace it. Nobody. It can't be done. So I think if they really wanted the pork, they would come to the United States and just pay the tariff. But I think the strategy that they would be more likely to pursue, as something that they've kind of done with soybeans also, is to pursue alternate sources, right? Chickens, poultry, they have been importing U.S. poultry. So they've already started that little system. They are planning ahead, and I think that's the most obvious answer, is the white meat, the sort of affordable protein that they could get, not just from the United States, but from other countries, yeah.
Okay, again, putting you on the spot here a little bit. What is Class 3 going to do in 2019?
No idea. Pass. But I will say, if I'm going to take it back to corn a little bit, that I mentioned all of these demand sectors that were, mildly optimistic. Ethanol is kind of limping along, cattle feeding is kind of limping along. The dairy herd liquidation, that is not helpful. But the dairy herd liquidation then implies that eventually you'll get the herd down to a level where there won't be an overproduction of milk. But it might not be in 2019. It might be a matter of years before we see a real recovery in milk profitability.
And you actually just kind of touched on this next one here, but could you provide any input on the dairy markets or your opinion on the state of the industry?
Yeah, there you go. That was it. But I do have a question of my own. Why is this cow on my slide, if we can pull up my goofy slide here, why is there a cow in a gas mask? What is that cow doing? I'll answer it. So all of my goofy illustrations here today, I went to the internet, right? I sold my granary for $300 on Craigslist, and I got all of my illustrations on the internet. Some guy in Macedonia was this illustrator, and he drew these cute illustrations for me, and I said, can you draw me some farmers in gas masks like it's the apocalypse? And he did, and he sent them to me, and they were really cute. I'm like, that's great. Okay, now can you draw me some animals? Can you draw me a cow in a gas mask and a pig in a gas mask? And so he sent me this, because apparently his English isn't that great. He drew me a cow in a gas mask. A Holstein. Anyway, no, I think the dairy industry, it's not looking great right now, but the cure for low prices is low prices, right? Eventually, I don't think it'll be a recovery quickly within a year.
Okay, and again, following that, do higher expected grain prices early in the year mean dairy farmers should be buying feed grains later in the year now?
Yeah, I don't think there's any particular hurry to be locking in feed prices right now. I think when I showed that sort of long-term, very flat, range-bound performance of the corn market specifically as a benchmark for all of feed, the feed markets are toward the top end of their 4-year range. So as long as it just continues to bounce along inside of that range, then yes, I think you wait until it's in the bottom 25% of that range, until futures are back below 350 is, I think, an easy thing to expect and to wait for. I would not be in a hurry to be locking in feed prices.
Okay, more here. Long-term spring wheat outlook. Seems like Russia will continue to take away our world market share in wheat.
Well, not this year. Not this year. It's sounding like they had a bad enough summer and they're facing enough of a domestic shortage potentially that just today there was again these rumors of them potentially shutting off exports. And those are just rumors, and we haven't seen a huge response in the futures market. Like the boy who cried wolf, if you threaten this rumor too many times, the futures market stops caring. But fortunately, as far as the actual physical competition of Russian exports to good buyers in Africa, North Africa, et cetera, I think there's opportunities for U.S. wheat, and we have seen that in the overall movement of U.S. wheat, the bushels movement. It's been not terrible. Prices haven't followed along because there's enough of the stuff. Again, it's enough of the stuff.
Okay, shifting a little bit here to soybeans. Is China really getting our soybeans just in a roundabout way?
I wonder that myself. I love a good conspiracy theory. And I've always wondered this because you look at the basis spread between northern North Dakota and southern Manitoba, and a truck could put soybeans up in Canada and make that spread work for the shipping spread on it. My understanding is that legally you still can't sell U.S. soybeans from Canada to China. You would still have to pay the tariff on it. But whether or not that's happening or not, I have no idea. Yeah, it's an interesting question.
So what % of my corn should I hedge by March 30th?
So I would like to have 30% hedged early. I would always say have 30% hedged by that April 1st time. Yeah, that would be a benchmark on any given year. If we were blind to everything that's going on, that would be my rule of thumb. But this year I would move that 30% earlier. Don't give yourself a March 30th deadline. Maybe give yourself a deadline sometime in February before the crop insurance rates get sold.
Okay, so what is your opinion on the future of ethanol industry and how will it affect our corn market?
Yeah, Jack's stuff about the electric cars and whatnot, that's really spot on. Long term, that is a threat to fossil fuel consumption, and if there's a threat to fossil fuel consumption, then there's a threat to the ethanol that's being blended in those fossil fuels. So we're waiting to receive the publication of the E15, the final E15 guidelines. And it kind of doesn't really matter. It kind of never mattered. There was never really a blend wall, because even if there was a maximum amount of ethanol that could be sold in the United States, as long as it was a profitable thing to produce, and as long as it was a profitable octane booster to put in international fuel, there was always an international export market for other countries, like India even, or South American countries that are trying to obey their commitments to the Paris climate change. So there's always been a good steady market for exported ethanol, even if we don't need enough of it in the United States. But The problem is, so the E15 thing, like let's assume that gets done and that's out there. It's not the instant savior that we'd want it to be. It was never a huge problem in my opinion in the first place, and it's not a huge savior now because I think you do have dwindling fossil fuels consumption over time, over the next 10, 15 years from these electric cars or from just consumer behavior, especially if you had a recession. Oh boy, let's not, I won't say the R word again.
And again, raise your hand here in the audience.
Yeah.
We got mics, so feel free to ask questions. How much has the drought in Brazil really affected their yields?
Yeah, well, I'm terrible at math in my head and I don't have my calculator here, but when the season was starting, just based on the acreage that they planted, you were talking about 122 million metric tons or 125 million metric tons. And now as the drought and the heat, the dryness and the heat have sort of limited those prospects as the pod filling is really happening right now at this time frame in the year, you're talking more like 115 million metric tons. So it's shaved off 10, so that's not 10%, that's less than 10%.
And any other questions here from the audience? Again, raise your hand if you have a question for Elaine.
I don't bite.
If not, Elaine, very interesting information, and I am up with my questions. So again, appreciate you sharing your input today, and thanks for being here.
Thank you.